All right, Ken Range Stereo Trader back with you with another video showing you this secret CRT model that's not often taught, the 5-9 trading model. So let's get right into it. So the 5-9 pattern is a 2 candle pattern. All right, typically when you see CRT videos, they're going to talk about 3 candles, sometimes it's 5 candles, whatever. This is just 2. Very simple, very easy. The first candle is the 5 a.m. candle on the 4-hour chart. So every single day, you're going to start with the 4-hour range. And it should form, or it does form, between 5 a.m. to 9 a.m. Eastern Standard Time, which is just the majority of the London session. Okay, that's that. You will start trading if you choose to adopt this pattern at 9 a.m. and your trading day ends at 1 p.m. So your hours are already set. You're looking to take an entry the next 4-hour window. And that's all. All we're looking to do is to take price from the high or low from the 5 a.m. candle range and then back down to it for a reversal of price. And that's it. So you're not concerned about trend. You're not doing daily biases. You're not looking for any order blocks or fair value gaps. None of that is relevant. Your price target is the opposite side of the 5 a.m. range, or just want to fix risk reward. So if you want a 1 to 2, 1 to 3, whatever the range allows, sometimes price will break out of the range, as you see in this example. But let's get further into it here. Now, here's the main thing that you have to remember: the high and low of the day must form after 9. Okay, that's what we're trading off of. That's what's going to give us the reversal. So, for example, in this candle right here, this is the high of the day right here. This is a short example. This is the 5 a.m. range. This is the new high of the day created between 9 a.m. and 1 p.m. and price tanks. That's all you're looking for if you're going short. Okay, so here's the decision flow. These are your steps, your checklists. Take a screenshot, write it down, do whatever you got to do to commit this to memory. Your trading day starts at 9 a.m. If you want to start at 8:55, even better. Okay. The first thing you're going to look at is the 5 a.m. candle created the current high or low of the day. Okay. So if the high or low of the day was created anywhere between like 1 to 4, 1 to 5 a.m., no. The high or low of the day should have been created between 5 and 9 a.m. Okay. And that's it. Now, here's the thing. You also then want to see, once you drop down to a 5 or 15-minute chart, ideally 5-minute chart, I believe is best, has a new high or low of the day been made? And then has price closed back inside of that 5 a.m. range by 1 p.m. Eastern Standard Time. Okay, that's the cutoff. If it does not do that, there is no trade. Okay, when all those criteria are met, where the 9 a.m. candle creates the new high or low of the day, okay, and then closes back inside the 5 the 5 a.m. range, you're going to take the trade and set your stop loss above the high or below the low of the day. And I'm going to show you this so you can see it visually instead of listening to me fumbling all over these words. Okay, so if the price does not close back inside the 5 a.m. range by 1 p.m. or just the next 4-hour candle close, there is no setup. So here's how it looks. And before I get to that, though, this indicator on TradingView will just label all of that, all those price levels for you. It's going to, well, not all of them, but it's going to label the high of the day, the low of the day, and the day open. Okay, so this is, if you go to TradingView, type in mark levels and scroll down a little bit to the bottom, this is all you're going to need to have checked: the day, the open, swept, and current. That's it. So this is how it looks. This is a short example. So let's say you come to the chart. All you're looking at is one candle. Okay, 5 to 9. Okay, this is the price action between 5 to 9 on the 4-hour chart. In this example, as a short, the high of the day should be right here. Okay, it's better if price closes near the high of the current day. Okay, and then starting at 9, what you want to see between 9 and 1 is price just go above it and close back inside of it. And it needs to do this by 1 p.m. That's it. The easiest way to do this, so you're not sitting at the chart all day, is just set a price alert at the high of the day, wait for it to break, and then wait for it to close back inside. That's it. And if the alert doesn't go off, that means there was no trade. Price just stayed below the level. There's no trade there. It is what it is. Okay. Now, in terms of where you get in at, you get in right at the range's high, the CRT high, right there. As soon as it closes below that level, you're in. Your stop loss is above the high of the day. Done. You don't even have to think when you're using this method. Same thing for a long example, 4 a.m. candle. Better if price closes near the low of the day. Price goes below the low, close back inside of it. Your entry is right here or as close to it as possible. You just buy there and your take profit is that fixed risk to reward or the opposite side of the range. Okay. So here are a couple long examples. So this is the 5 a.m. candle right here. This big old long red candle. See how it closes close to the low? And then there's a new low made between 9 a.m. and 1. Okay. It creates the low, pokes below it, closes inside of it. As soon as it starts to close inside, you're in. How you know you got it is by 1 p.m. If your entry is inside of the wick of the candle, that's ideal because see how this formed a wick? This was solid red at one point, but it closed all the way up here and then closed out the range up to the daily open price. Okay? This is on Australian yen. But let's take a look at the 5-minute chart, see how it looks. Okay, so this where the yellow box starts, you don't need this, but I just put it on there just for the sake of ease of seeing it. Okay, see how price tanks below 5 a.m., consolidates a little bit, shoots above it, retraces a little bit. Best entry, you could have got in here at this first close, or if you want to wait for a little bit of a retrace, that's fine. Best entry would have been right at 10:55 a.m. This would have been good for 1 to 3. All right. Remember to scale into your positions though to make it worth your while. So that's that one. So this, okay, is this on the 5-minute chart. All right. That's all that is. Let's take a look at one more. This here is the 5 a.m. candle. See how it closed close to the low of the day and then made a new low of the day right here. Price poked all the way below. So anybody who went long here, either they had to sit through all this drawdown or they just got stopped out. But then remember, this used to be solid red and then it comes right back up. You caught the wick and then price just comes up. And that's it. You're done. Let's take a look at the entry though. This was good for 50 pips. I think a 50 pip max take profit is ideal for this setup. And you should be able to get it if the range allows. So all this, you're not trading outside of the range. This is not your zone. You need to wait for price to close back inside the range, and you're counting on price to just stay inside of it and do a straight rise. That's all you're looking for. Okay, so let's take a look at one more. Here's your 5 a.m. range. Small ranges can be good too. And then it's starting at 9, where your price, where your trading window starts. Price goes below, creates a new low of the day, and bang, shoots up. I don't know if this was news driven or not, but obviously this went for a lot more than 50 pips. But you could have got 50 pips off of it. The best entry was at 920. It just pinned it, didn't give you much time. Anywhere around here is fine, but then once it takes off, it does not come back. Okay, but that's as simple. It's just the 5 a.m. range that creates the old low of the day right here, and then it creates a new low of the day right here. This could also just be looked at as a W pattern, okay? For you guys to know that. That's leg 1, leg 2, okay? So this isn't anything new, I promise. This is just a way to look at it, okay? All you have to do is define your range and just look for what you want to see. So here are some short examples. So here we go. This is pound yen. We have our 5 a.m. range here. Now notice though, it closed down here. All right, but you never know. As long as it creates the high of the day, because the old high of the day was here, went up here, and then price spiked all the way up and then closed all the way down here. So you really just don't know. But the best thing is that it only sweeps one side of the range. Okay, so in this case, it sweeps the high. So if it's sweeping the high, I'm going short. So let's see our best entry. Okay, see how price rocketed up. It went outside the range, closed back inside of it at 1040. This would have been good for about 40 pips. Or 1 to 4, because the stop loss was about 10 pips. Okay, you should be able to get away with about 10 to 15 pips for a stop loss most times. Okay, but once price closes back inside of it, this is again a 5-minute chart, you're good to go. Let's take a look at one more. Once again, we have a short example where you have a doji pattern here, or doji candle here for 5 a.m. We look for price to sweep one side, which it did first here. It created a new high of the day here. So as soon as price closes back inside the range, that's our entry point. So let's see how it looks on the 5-minute. Pike poked above the range, closed back inside of it, consolidated a little bit. It enticed a few more people to go long and then just tanked. All right. So these are not trades that you're holding for days on end. These are perfect for day trades. Remember, you want to scale in though to like 2 to 3 entries. That way, this is about a 1 to 3.5 risk to reward ratio here. But obviously, if you're risking like $5 to make 15, that's not a lot. But if you're risking $5 to make 15 on 3 different entries, that's 15, and then you got 30, and then you got 45. right? If my math serves. Or if you're risking $10 per entry, that's 10. Who knows? That's if you're risking 10 to make 30, that's 30, 60, 90. So this could be almost $100 a day if you're risking $10 per entry. Okay. So things like that, though, that's what make it worthwhile, not just necessarily one entry. Okay. So scale into these things, get your money, get out, go on about your day. All right. So in conclusion, this model is perfect for scalpers and day traders, not swing traders. Remember, 5 a.m. though, don't skip this step. 5 a.m. candle has to have the title of having the current high or low of day, and you just look for that high or low of day to be swept or a new one to be created, and then price to reverse. It is better if that 5 a.m. candle closes above its high or near its high or low. Like, for instance, this one here. See how it closed pretty close to the low, or this one here closed close to the low, and then a new low gets created, and then you just look for the reversal. That's it. Now it's not 100% though, obviously, as you see, because these other examples, it didn't close near the low at all. So it's not predictable. It's just best if it closed near its bottom. All right, but see, this one closed here and went all the way back up here, and then closed back down here. So don't try to participate. Don't try to predict what you think price is going to do, and think, okay, well, it closed here, so I'm going to try to go long. It never hit this level. It went back up, got some more people trying to go long, and everybody who went long up here was toast that day because price came right back down. So trade what you see. Don't predict, just react to what you see. Okay. All right. Good. Okay. Risk management is still number one. Don't try to scale into tons of positions and blow your account. So scale in, but don't use all your margin. Use about half of it or so. So if you got $100 account, maybe take $50 to $60 worth of positions. Okay. But don't go all in on one and try to just make $1,000 off a $50 account. We're not teaching you how to do that. Okay. So your setup must play out by 1 p.m. That's the cutoff time. Your trading hours are already set. You do not get paid to work overtime in Forex. Okay. If your setup doesn't appear by 1, you want to give it another 4 hours, you're outside of what I'm teaching. I don't know what's going to work out. Could it still work out? Yeah. But is that the 5-9 model? No. This model ends at 1 p.m. because the 4-hour candle closes at that time frame. If there's no setup, there's no trade. That's it. So set price alerts on TradingView at the high or low of the pairs that you're watching. So you don't have to sit at the charts all day. TradingView does give you the option to have that sent to your phone. Just look up how to do that. I'm not teaching that, but it's fairly simple. And just set those price alerts. That way, when the alert shows up, take a look at the chart, see if something's cooking. And if so, go ahead and get in. Okay. Now, I did include a ton of examples because you need to be the one back testing this. But you don't have to backtest endlessly. I don't believe you need thousands of screenshots. It's all the same thing over and over. It's just this for a short and that for a long. It's still doing the same thing over and over. It's going to sweep this range and then close inside of it and go in a straight line. That's all you're looking for. So get about 10 long examples, 10 short examples that all take place between 9 a.m. and 1 p.m. Refer to them every now and then. And then if you adopt this model, it'll come to you like second nature. Okay. That's really it. So that's the 5-9 model. Again, it's a 2-candle pattern that you can use to be a proficient trader and master the art of day trading. This is all you're looking for: a simple range and then price to sweep one side of it and close. That is it. That is the 5-9 pattern. Very simple, very easy. A child could do this. Okay. So thank you for watching. I appreciate your time and attention. Hope you have a great rest of your day and take care.